All right, welcome back to the Applied MMT live stream. It's Friday night. We're in for a good one tonight. Welcome back, chat. Thank you for dropping by. We got a lot to cover tonight. We really do. I've got an hour to cover it all. As you all know, Friday night is game night with the boys, so we're gonna be switching over to. Hold on one second, crew. We're going to be switching over to Twitch later tonight, so if that's something you're interested in, I'll give you the link at the end if you're still here. But anyway, we have a lot to talk about. We had markets finally starting to sell off. We've been anticipating this for a while now, and then we had obviously the big CPI surprise earlier this week. I want to talk CPI, where I think rates are going, where I think what the Fed is up to, and then we have what else do we got to discuss tonight? Also, yeah, some tweets that I want to go over as well, engaging with some other content. So, anyway. Going to be a good one tonight. Let's see. Where do we want to start? Chat, make sure you say hi if you are there. Drop a line in, hit that like button, all that good stuff, and then we will get underway. All right, let's do this. 1 second. Go ahead and pull up the S&P 500 again. We've been seeing some selling take place, and if you've been following the Twitter feed or anything like that, you know that that we were anticipating a sell-off here probably by April or sometime April, maybe into May, and certainly that is underway. And for the most part here, also chat. If you're in chat, make sure you say hi. I'm not seeing any chat come in, so I want to make sure everything is rolling well there. But anyway, to the point here, really, this is probably the most selling that we've seen, or the most volatility that we've seen going back to the December, January, early December, late December, early January sell-off. And I think in terms of volatility, I can pull that up real quick. Let me pull up my VIX. Yo, howdy, Echo Skeleton. Thanks for dropping in. What is it? What is it called? I think it's a VIX. I call it VIX Bollinger Band, but I can't find it right now. There we go, VIX BB. Let's actually pull that chart up. And yeah, in terms of volatility, in terms of kind of spikes of volatility here, this is the most volatility we have seen since that pop. I guess it was February. I guess we had even more volatility in the brief pause in February than we did in that January pullback. But either way, the most volatility that we've seen now since the sell-off that we saw in the fall months of 2023. So we're starting to see that volatility pile up here, and to me, very little surprise. This is usually when flows begin to fall off a cliff, so to speak, and we're seeing that. We'll look over that flow data as well, but the selling has begun. Again, as I've been tweeting out, as I've been kind of setting up for this exact moment, the bears are going to be coming out of the woodwork here, no doubt about it. Bears are going to be coming out of the woodwork already. Getting a little poke on Twitter for those the bears, but. Or from the bears, being how bullish I've been, but this is right in line with our expectations here in terms of volatility and in terms of selling, given where flows are at. What really kicked off the selling, and really what kicked off the volatility, of course, was the CPI print that came out on Wednesday. And I'll tell you, the way to look, or the way to watch CPI as it kind of happens live, and to really understand what the potential implication is of CPI or any big macro print, any big macro data drop. The real key is to go to something like the MyFX book or any other data conglomerate that has a consensus market opinion as to where that data should be at. That's the way to look at it and find out what consensus is at. So the inflation rate year over year the consensus was 3.4. It turned out to be 3.5. Core inflation ended up being much larger than expected. Was it core? No, core was intact. I think the inflation rate I guess it must have just been the inflation rate year over year that was much hotter than expected, but we ended up seeing a much bigger print relative to expectation, and that's the way to watch this. Look at what expectations are, and then look at what the print ultimately is, because it's relative to expectation that the move is going to happen, and that might impact the market. And a lot of the hedging activity that will shift, that will cause big moves in the market, is relative to where expectations are. And I think we finally got enough of a surprise on the print that it spooked markets into the sell-off, because it's very, very clear now that cuts are not coming anytime soon. Obviously, going all the way back to the beginning of the year, maybe even late 2023, there was anticipation for cuts early 2024. I mean, I think the expectation, I think some Fed officials were saying up to 4 or 5 cuts within 2024. It was almost certain that we would get the cut by March. Quickly that fell off, the odds of that fell off, and then it was definitely by May, and then definitely by June, and slowly but surely we're seeing the odds of a cut completely crumble. And what happens here, right? Because in theory, right, the market should have figured this out by now. In theory, the market should be understanding that this higher rate regime is adding all this interest income, and that maybe there's this positioning that maybe was there in 2022 that would get spooked by these market hikes, or the rate hikes, that maybe should fall away. But what is happening is there are certain kind of valuation appraisals that take place that do need to get adjusted when rate cuts aren't coming in, and there might be a one-time price adjustment that occurs, and we likely saw that during this month's CPI print. There's also just other things too, where hedging will take place around a big announcement, and it just becomes a self-fulfilling prophecy, where if the announcement is further off than what would have been expected, the hedging that comes in ends up reinforcing the downside when there's the big miss. So there's an immediate big miss, and then there's hedging flows that reinforce whatever the downside selling is that happens after that big miss, and it just gets reinforced into the actual price of the market, and then you can't escape that reinforcement. It's a self-fulfilling prophecy, not only in the fact that it immediately reinforces, but then also more puts are open as protection is hedging, and that just reinforces the selling even more. And then it also reinforces the misbelief that a rate cut would have been more stimulative had it not happened either. So you end up seeing that kind of knock-on effect play out. And I think that's exactly where we're at. It's happening too. What's interesting about this moment in time is that it's happening as we are entering a slowdown in underlying flows that are only just going to compound the kind of negative effects that are already there because of the interpretation of now the lack of rate cuts. So rate cuts quickly coming off the table here. June, almost a certainty now that we're not going to get a cut by June. Even July is 50-50 at this point. So the next real opportunity is going to be September. And obviously, as we have now seen to this point, this economy is just running way too hot. I think we saw a beat of GDP. We saw inflation come in too hot. A couple weeks we'll get, maybe it might be next week, we'll get jobs data. And that continues to be the big three that you need to track to understand what the Fed is going to do, and those are just going to continue to come in much hotter than expected across the board. So the theme from 2023, the hotter than expected theme from 2023, continues on, and the odds of a rate cut are quickly diminishing. And again, the market is going to get spooked by this intermittently, especially when it aligns with flows that are easing. But we shouldn't be. Higher rates are going to continue to drive this market for better or worse. It is what supported us in 2022 and allowed us to get that very strong 2023. And there's no reason to believe at this point that any of that is going to change. It's one of the things we'll talk about later in the live stream. Bob E. Unlimited, Bob Elliott, had a whole thread where he tried to explain that the whole interest income idea is not actually relevant or applicable to markets. And I'll go ahead and engage in that a little bit tonight during the stream. Warren Mosler actually had a really good interview with Real Vision. If you haven't watched it yet, he tweeted it out. It's worth a listen. He explains a lot of concepts. The interview gets a little frustrating in the sense that it's like, why are we going over this all over again? But with that being said, Larry Summers, where's Larry Summers? He's probably off enjoying his Friday night. I don't know, with his wife. Hopefully he jumps in though. But anyway, back to the Real Vision interview. It gets a little frustrating. I've already been through this a while or a few times myself, where it's like, okay. We're just it's like Groundhog's Day with the exact same questions over and over again. But it was a good interview because they were sincere questions, and you could tell it was someone who's trying to understand the train of thought that Warren has. And from that aspect, it's a good interview to learn the kind of applied MMT approach. And I got to tell you, I know Warren reads all of our updates and sees all the updates on applied MMT, and he's communicated a few times about some of the ideas, and we are absolutely in line with a lot of things and a lot of the data that we track. He even mentions, not the specific, doesn't mention our site, but the data that we find the most important, he's referencing in this interview well at applicable times. So it's worth watching to get a better understanding. But a lot of this interview was this hairy guy asking Warren about Bob's tweets to understand. So we'll debunk or at least break down Bob's tweets in just a second here, and go over that and the implication, and kind of just continue to give that applied MMT understanding. And it just, if anything, so I mean, the premise of it, I guess I can just kind of pull up the tweet. We can start going over it now. The premise of this is that the rate hikes really aren't the driving force of the growth that we've seen over the last year and a half. And he essentially spells out why that is the case. And I think overall, the summary here, or at least my initial takeaway is, you're only going to get growth from one of two channels. You can really only get growth from one of two channels, in terms of, at least certainly in terms of nominal growth. Only going to happen from one of two channels. Either one, the government's going to spend more, and that's going to add more income into the private sector. That income is going to cycle around the private sector, and that's going to lead to GDP growth. Option number two is you're going to get an endogenous expansion of money, so the credit cycle is going to increase, and then therefore you can see GDP growth from that as those business transactions take place. One of those two things have to be happening, or we have to get a massive increase in exports, and therefore we're getting financial assets in from the private sector, and that can also boost GDP, right? So you got three avenues for this, and only one of those is increasing at a phenomenal amount month over month, year over year, and that is going to be the fiscal. And certainly I'd be the first person to admit 2022, 2023, we were not seeing a massive acceleration in bank credit. So growth could only really be coming from one spot, and it has to be the fiscal. So we'll break this all down. We'll go over it in just a minute. I think the next thing I wanted to talk about was, and by the way, just real quick, seeing a couple names jump in chat again. Echo, welcome. Bully Pulpit, welcome as well. Gavin, how you doing? Hey, Zeus, welcome. I think where I want to go next is let's see. Let's stay on the stock idea here, and let's stay on where markets are going. Because one thing I did want to do tonight is go over some data that I'm seeing. So I think what I'm going to look at first is I want to go to the Treasury statement, the flows. And actually where I'll scroll down to is the fact that we are starting to see the big drawdowns and the big negative net flows from the tax drain starting to occur for the most part. I mean, if I scroll down over the months here, you'll see the occasional periods where we do get these little tax drains, but for the most part, heading up into this inflection point, this juncture of April, a lot of green and very little red in terms of tax flows, and we're starting to get the tax drain to pile up, and it will hit very, very strong on April 15th. And that will certainly have implications, and from like a longer term perspective, in terms of just the trend of flows, that 90-day average that I like to track that correlates well with markets. We saw that peak in early March, and that is starting to fall off and decelerate as well. And historically, after April, we can kind of zoom into the pre-COVID era and look at when we usually bottom. It's right at the end of April when we usually bottom, and then we start to take off into May, and then we have a June tax decrease and or I'm sorry, tax drain, and then at that point there's a window there, June into July, where markets can get a bit of a clip as well, and so we're getting very close to that peak tax season. One point to this as well, and this was brought up, and I apologize that I never was able to get back to you on Twitter. I forgot who asked it, but the question was, and hopefully you're watching this, I'll try and find it and get back. But the point was, they pointed out some chart that historically April is strong up until, the month of April is strong, and so the impact of the tax drain is usually not felt in April. And my data says the exact same thing, that the average return going back to 1980 through the end of April is positive through the very end, and it's right at the very end where we start to level out into May, and it's usually May that actually feels the brunt of the tax drain. So why am I not expecting a continued acceleration into the end of April? Above all else, we're just overbought here. We are so overbought and have been for quite some time. The other thing that also happens right at about this time is you can get, because of, there's usually a pretty strong rally into this point from really the beginning of March into this middle section of April, and then oftentimes the third weekend or the third Friday of the month is options expiration, so that's usually about the 19th, 20th of April. You'll get the dealer hedging to continue to support the upward trend into the very, very end of April. And so I think there's a handful of factors that are contributing to allow price to continue to push higher into the end of April, and then that finally gives way and you start to see the selling happen into May. Couple of things that are different this time. One, we just never had kind of the February, March pause at all from the tax drains that happen at that time frame. We never really even saw a pause at the beginning of the year. There's a tax drain. We just ripped right higher. And so from a pure momentum, sentiment, extreme style of vantage point, we're just overbought, and we are particularly sensitive here to a sell-off. Could we have continued to churn higher? Absolutely. Could we even continue to churn higher into the end of April? I mean, do we have to have a sell-off into the end of April? No. The hedging flows haven't completely collapsed, but we're getting really, really close, and this is certainly the most brittle markets have been in quite some time. So would I be absolutely surprised if all of a sudden we surged heading into next week into the end of OPEX? Nope. It's a very realistic possibility here, but we are certainly near the end of this big run-up, and I'm still very much anticipating that whether it's April or into May, that we continue to get this sell-off to materialize again, just because that underlying flow that has been there is finally being removed, and we're starting to see, we're just starting to see the tail end of this move hit right with flows diminishing. And on top of that, we're also just getting a real curveball from market expectations, that being this hotter than expected CPI, hotter than expected growth, the anticipation that we would get rate cuts, now diminishing. The hedging that would have been there had that data not come out would have been much more supportive of a slow grind higher. Ultimately, that data did come out, and so that hedging quickly shifted to a more reinforcing selling type regime. And so again, just adding to that brittleness, while the underlying flows just aren't there to continue to support price. So we're seeing that kind of play out here in real time, and that's kind of why I thought maybe we might end up getting a bit of an earlier sell-off heading into tax season, just because of those various factors all coming together right at one time. Hamel, I'm seeing too a really good question. What about the velocity of money? And again, that is one thing that can certainly help things overall. I guess, Hamel, are you asking this relative to what could be potentially increasing GDP? Was it in context of that? Follow that up and let me know if that's what the context was. Let's see. What else did I want to hit on before we moved? Yeah, a couple. Okay. Yeah. I'd have to think this through in terms of GDP, how velocity of money, or how the Yeah, you caught me a little flat-footed here on on the exact equation for GDP and what the implication would be. I guess the way I view velocity of money is not so much the way that you would in kind of a neoclassical or monetarist way, but more from kind of a circuit approach in terms of any unit of money, how fast it makes one full revolution around the circuit. And I know that will buffer growth, essentially. And I think that's one of the takeaways from Steve Keen's work. So I do think that is a potential implication of the velocity of money. I do think the other thing that I wanted to hit on here was one of the things that one of the trends that I have been watching, and maybe one of the first things where I don't say it's concerning, but and this is one of the key themes from last night's update at AppliedMMT, and that was we are starting to see that monthly Treasury spending start to wane just a little bit. And I think this is because of a combination of, and again, this is in real terms, this is inflation adjusted, so I'm dividing deficit spending or the change in deficit spending by inflation. And since inflation is coming in so hot, we're starting to see inflation really put pressure on the efficacy of new spending coming into the economy. And I'll zoom on in here. Give me a second to well, I guess I can just do this. We're starting to see that growth in deficit spending starting to roll over here in terms of the year-over-year change, and this is interesting because this is kind of showing me that we're seeing this, and this is always inevitable, but we're really seeing this transition from the fiscal channel being the predominant facilitator of growth to the credit channel being the predominant facilitator of growth. And if you look at what happened after 2009, after the great financial crisis, or after the dot-com bubble, or after the 91 recession, where there is the spending that came in, that is the automatic stabilizer spending, there's always this waning period, right? There's this period where the fiscal spending is effectively the driving force to growth immediately following a big contraction, and eventually you get the credit cycle to kick up, and there's always this transition where that fiscal begins to wane, the credit cycle begins to take off, and then it's the credit cycle that is really supportive, and there's this recovery period in the year or two after a recession or a big contraction where it is really just the fiscal that is dominating in terms of the flow, if you will, that is carrying the growth for markets. And so in this instance, we always see this waning that eventually occurs, and as long as there's sufficient growth to kind of capitalize the private sector will take off and will carry the torch. But there's this time frame, and it's effectively what we've been in for the last few months here, where we're starting to see both channels fire on both cylinders, and we're really going to enter unprecedented territory at this point, because usually we're going into this time frame with 0% interest rates, but this time we're going to be going into this time frame with 5.25 or whatever it's at, and the potential now to even hike, and so we're starting to see this transition where we're going to start to see fiscal fall off. We're still very bullish here. I don't want to start selling this as potentially bearish, but this is the first step that has to happen for the business cycle to play out. And again, we know that the deficit spending continues to increase because of the higher interest rates. So what's likely causing this is inflation starting to creep up, diminishing the effect of every new dollar spent relative to the dollars that were out there, and it's starting to kind of take hold here. I don't have it pulled up, so give me 1 second, but what I do want to pull up, and I'll be interested too because this data comes out today, it's the bank credit. All right, we'll switch back over, H.8 bank credit. And let's see, we continue to see bank credit overall just really reaccelerate. So we were down week over week, so maybe that acceleration will be slowing down just a bit. But overall here, starting to see bank credit really start to take off. And in fact, I think even loans and leases taking off. So we're really seeing this transition between this really fiscal vertical channel that is dominating growth now to this horizontal exogenous money expansion that will eventually take over, and we're kind of switching tracks here. So the longer term story here is that we're going to get this little sell off that will take place over the next month or two, but we will be right back on track for a big rally, and certainly an overall bullish market regime and an overall kind of bullish growth regime will remain and continue to stupefy the monetarists and the neoclassicals and the Austrians alike. This will be a really perfect bear trap, and if things get nasty enough too, I'm certain the bears will all climb aboard to the end of the world hype train, but will be thoroughly disappointed come May because the flows will be kicking right back into high gear. It's just a matter of how deep does the drain occur in April to really kind of reset markets here. But overall, I fully anticipate flows to be kicking back into full gear as we head into May. All right, I think the next thing I wanted to talk about was let's go ahead and look at Bob's tweet here. Actually, before we get to Bob's tweet, what I want to do is take a brief pause here and kind of look at what the Fed is going to likely be doing next, and why I continue to think, again, but my hypothesis is this going forward. Let me just kind of lay this out, and if you listen to our 2024 Outlook podcast, this is exactly what I stated in the 2024 Outlook podcast. My ultimate argument was this. I thought there's no way the Fed ends up cutting by the end of the year. And if anything, my bet would be on rate hikes. And actually, I mean, as it is, I've got TLT as the bar here. I can turn off the S&P. TLT as the bar here. And certainly from the beginning of the year to where we're at now, at least TLT, the long-dated bond, ETF continues to push lower here, obviously aligning with my expectation that rate cuts were never going to happen. And so that was my expectation. The Fed will never cut rates, and the reason for that is what the Fed is looking for to cut rates is a slowdown in growth, a slowdown in inflation, or a slowdown in overall employment, because they think, their theory is that lower interest rates is going to be stimulative to growth. Now, I've been making the argument for quite some time that higher interest rates are actually stimulative for growth. Lower interest rates are not stimulative for growth, and that if anything, lower interest rates just reduces the overall desire for risk, and that the Fed has it all backwards. That's really been kind of my thesis. And actually, you know what we're going to do? We're gonna do this. We're gonna run over to Twitter, and I reposted this, and it's probably worth a rundown again. This thread right here in terms of what's actually playing out for the rate hikes, and there was such a the mainstream has such a one-dimensional view on rate hikes, and I think laying it out like this in kind of like a cause and effect, or just the entire cycle of what the rate hikes are doing, like when you lay it out like this, it's very clear that there's more that's happening than just making things more expensive or dampening the desire for more credit, right? And that seems to be the big miss, is that no one wants to think about the other impacts of rate hikes, and they get just laser focused on this idea that is dampening credit demand, when really the thing that drives credit demand is income, not rates necessarily. So we'll go through this. And what I really want to do, and the picture I want to paint, is just not only look at the immediate effect of rate hikes, which I have all the arrows pointing to the things that we'll call this on the first order rate hikes do, but also look at the second order effects and the knock-on effects that occur as implications of the rate hikes, and just realize that as you bring this down the chain, that you realize rate hikes are doing a lot more stimulative work as a whole, when looked at as a whole, than they are doing anything that's doing anything that's contractionary by any stretch. So if you're trying to piece together the overall argument as to why we think rate hikes are stimulative, we'll go over that right now and kind of show you how this all plays out. So the very first thing I want to make sure my mouse is showing on stream. It is. All right. So the very first thing is we're going to look at what the rate hikes are doing, the red line. They are increasing the term structure of prices, and they are increasing the future cost of doing business. So there's no doubt that when you hike rates, so when the Fed hikes rates, and another thing too that I should probably add here is I wholeheartedly believe that the Fed is the monopoly price setter of rates across the entire term structure, right? So effectively what the entire term structure of the rate term structure is looking at is they're just looking at what is their best guess over that time frame as to where rates will be, where the Fed will have rates set during that time frame, right? So there's no free market determination. I mean, there is, because it's left up to the free market, but the free market is just trying to guess what the monopoly price setter is trying to do. So that's all that the yield curve is. And so the Fed, when they're setting the rate, they're the monopoly price setter, and everyone's just going to track then, or the curve is going to track what the expectation of what the Fed is going to do at that point. So when the Fed sets the rate, what they're doing is they're influencing the entire curve, looking out the entire yield curve, looking out, and they're increasing then the future cost of doing business. And there's a great video on YouTube. We've linked it many times, and you can certainly find it. It's just Warren Mosler, term structure of prices. You look it up, you'll find it. But he explains this whole process very clearly, that what's happening is the future cost of doing business is increasing across the board. And you can see this in commodities. You can see this in the cost of borrowing. Without a doubt, the future cost relative to today's cost is higher. Now, that does not mean that the spot price rises necessarily. Now, gold, we have seen the spot price rise, but there's a lot of commodities where the spot price hasn't risen. But when you look at the term structure of the individual commodities, the most forward-looking contracts are more expensive than the contracts today, the more near-term contracts, and that's an exact cause of the interest rate being pushed higher. So again, I want to make it very clear that I'm not saying that any commodity per se is going to be higher in price than the spot price. It's the contract price, the term structure of the futures of the underlying commodity. That is what is being pushed higher in their own individual term structure. Furthermore, just the cost of borrowing as well is going to be more expensive. So that is the part of this that I kind of agree with, and I think there's an agreement that amongst everyone that is, if isolated, that is the negative impact of rates. It certainly does make things more expensive, but that's not the only thing that rates are doing. Rate hikes are also adding additional interest income into the private sector. So they're making things more expensive in the future. They're also adding the necessary income to support that price structure, right? And so that's why I have the green arrow also pointing to the increase in the term structure of prices. I also have the green arrow pointing to supporting the higher prices as well. Because if you think about it, you can't have higher prices for all that long unless there's more money to support those higher prices, right? And so I'm sympathetic to the view if the Fed could get away with it and not actually pay more interest income, that would be highly deflationary. Things would just be more expensive and there wouldn't be more money to buy things at a more expensive price, and that would absolutely collapse the economy. But it's very clear that money is being put back into the private sector. Now, when we get to the Bob thread, we'll go over the fact that a lot of people think that there's this marginal propensity to save, or there's a lack of a marginal propensity to consume, and that income isn't finding its way. But I'm not... I can tell you the data just doesn't support that view, but we'll get to that. So yeah, there's that view. However, it's very clear that the interest income is finding its way into the private sector and supporting this higher structure, this higher price structure. So that is one of the impacts that is happening. And again, I would call that like a second order impact, right? So the first order is the rate hike is adding the interest income. And then the second order is the interest income is now supporting the higher term structure of prices. The other thing that's happening is you get this higher term structure of prices, which also then pulls forward the demand, right? So you actually get an acceleration of demand. And you also get, because of this as a consequence, you're going to accelerate the demand for higher income as well. And there's unfortunately, the data only goes back to like 2010 that I can get. And within that amount of time, there's a brief correlation there that seems significant enough. But again, we're dealing on a pretty short time frame here. But it does seem that there's at least a demand for higher income. Now, I realize wages are certainly lagging the push here higher in inflation, and I get that, and I'm not saying that this is like the panacea that we found, that higher rates are just great. I don't disagree that there's kind of a regressive potential here, but you're still seeing the demand for higher wages play out, and the push for workers to find those higher wages, to take new jobs, which again is now, I'm going to kind of call this a third order effect. So the rate hikes increase the term structure of prices. They add the additional interest income, which makes the desire demand higher for, or I should say, it's going to accelerate the demand for higher income, which then in turn drives continued job growth, which we're going to feed this all the way back into the final point here, which signals the Fed to continue to hike rates even more, right? And so this goes back to my initial point all the way back at the start of this year, why I thought the Fed would never end up cutting rates, is because the signals that they're going to get are not going to support their need to cut rates. They cut rates because they think what they've done in step one has done enough to kind of collapse the economy. And my argument is there's no way for step one to be the predominant factor to then affect everything else, in part because at least at the first order after the rate hikes is that they're adding the additional interest income to support everything else. And then you get the cycle to continue. You also see asset prices push higher in this. There is the potential for commodities to push higher, like oil, which just supports inflation even more. Inflation as measured by CPI certainly starts to creep up. Again, we saw that this week. We're starting to see that reacceleration of CPI. I can pull that chart up here. Starting to see that surprise higher in CPI. And so we're getting that whole cycle to ramp up here. And as far as I'm aware, and I don't follow like Argentina all that closely, but as far as I'm aware, this is exactly what Argentina has been doing for quite a few decades now in a row. And granted, their overall economy is much different than the U.S. is, but they continue to get this. This push higher that never really leads to a disinflationary collapse, just continues to push higher. Of course, this deflationary collapse might finally happen in Argentina now that there's a political change, but overall, it is just a spiral higher in inflation and, at least in nominal terms, growth. Obviously, in real terms, you're not getting any growth out of that. Above all, my point here is that this is just it's going to continue to support growth, and it's going to continue to support asset prices pushing higher. And certainly all the research I've done has shown that we get support of higher prices from this additional interest income, and we see this thing spiral higher. So that's my argument. That's why I think the Fed ultimately was never going to cut this year, is because all the signals that the Fed would look at, which were going to be inflation, which were going to be growth, which were going to be employment, were never going to come down, because those are not actually affected by, right? There's no causal efficacy from the rate hikes. And to drive this home a little bit more, you can, in terms of what the Fed is doing, right? So this is how it works, right? The Fed's going to look out. They're going to measure those three things: growth, employment, and inflation, and they're going to make their determination by that. And of course, if they think that the rate hike should be bringing this down, but in fact the rate hikes are accelerating it, then you should eventually find yourself in the scenario that we're in, where you just get this reinforced spiral upwards. And you'll see then that historically there is this correlation between, so right now I've got oil as kind of an inflation proxy and rates. You see this correlation between them pushing higher. And my argument would be that the causal jump here is from rates pushing higher into the commodity having the capacity to push higher. And again, it doesn't have to, but historically that's how it plays out, is that the Fed sees that the commodity is pushing higher, and usually the commodity is able to push higher because you get that expansion of the credit cycle after the recession, and the stabilized spending kicks in, the automatic stabilized spending kicks in to accelerate the demand, and then that demand pushes the asset price higher, and then that cycle kicks in where the Fed sees that, they hike rates, and that actually supports kind of the end game, the Minsky end game of that cycle pushing higher. Of course, this time we never had the contraction phase in 2022 to really take hold. We just had rates pushing higher, and so now we find ourselves in a scenario where we could spiral higher for quite a long time. So you're going to see inflation-sensitive commodities like oil lead what the Fed is doing, and then subsequently the Fed lead those commodities. And likewise, if you look at, say, the S&P for growth, again, you're going to see a bit of a correlation here over time. I think that even plays out if you look at the Fed funds rate and GDP. Yeah, Fed funds rate and GDP. And again, the thing that we're missing this time is we never got the rate cuts when we actually had the major collapse that took place in 2022, which we normally would have had, and if anything, that could have even caused a recession. We've gone over that in the past. But above all else, when you look to correlate the things that the Fed is looking at with what the Fed funds rate is doing, those things are being pushed higher, or being pushed in the direction of sending the signal to the Fed to continue to hike rates. And we're seeing the rest of the world realize what we've realized all along, which is there's just no way that the Fed is ultimately going to cut unless they come to a realization that what they're doing is actually continuing to support the kind of inflationary pressure that we continue to see. The final thing I'll say on inflation before we change gear here is it is in theory possible that inflation just kind of settles and inches ever so slightly higher. In other words, I think there's a lot of people that are looking for a repeat of what took place in the 1970s, and I think that's very possible, where we get this kind of echo inflation, the next wave of echo inflation. And so far, if you overlay the mid 70 boom to the early 80 boom, that they correlate really close between now and back then, and that could very well be the case, and we'd be right at that point where we're starting to see acceleration. But it could just kind of find a natural equilibrium point right around 5 to 6% year-over-year growth in CPI, and then we settle at that point. We don't have to spiral higher in terms of overall inflation, as long as growth remains very robust and production remains increasing over that time frame. We could support the additional interest income coming in without it being necessarily inflation. But we get even a hint of these sort of supply chain issues that we had in 2022, or 2020 to 2022. Inflation could get very, very bad. If we see oil take off, which I think it likely will, inflation could get very, very bad. So that is certainly the risk. And then if inflation does get bad, that is where we can start to see the end of the cycle begin to kick in, because deficit spending in real terms would begin to really diminish, and we could see ourselves in a period like the 1970s, or 2000 or 2008. Obviously, the scenario would be different every time. It's going to be a bit different, but we'll find ourselves in whatever version of that is, and then likely at that time we could really see some damage kick in, unless policy changes a lot at that point. But we're still a distance away. I know my estimation has been about $250 a barrel on oil until we get to that point, somewhere between $250 and $300 a barrel before we get to that point where oil is doing such a damaging effect on the overall impact of deficit spending, where it just becomes too much of a weight to handle. So that would be my guess, and obviously we're a bit of ways away from oil being that component, but supply chain stuff could happen, and that could certainly cause inflation to spike very, very quickly. And if it did, then the concern that I would have that right now is maybe a year and a half, 2 years out, that would be brought forward very, very quickly. So, all right, that's kind of the gist of where I'm seeing markets at inflation at right now. And if you're just tuning in, I led off with what we're seeing in markets and why we were anticipating the current sell-off, and why I'm not too worried about it in the long run, that it'll only be a matter of time before we get back to the good times. By good times, I just mean bullish markets. All right, I'm going to take a look at chat before we go over some tweets here. We got falsificationism. In reality, if the Fed thinks lowering interest rates stimulative the economy and rising rates puts the brakes on, and they've got it backwards, what are they willing into existence? What they're willing into existence is just a continued upward cycle here, I think. Let me know if I understood that question correctly. Yeah, glad the flowchart was helpful. I put that out about a year ago, and didn't get the traction that I thought it should. So maybe I'll have to find a better way to explain it. We got Ballistic asking gold yet? Yeah, I mean, gold's been on fire, and very little surprise. You know, Warren in the interview, the Real Vision interview that he had today, made a really good point that when you have very regressive spending, you're going to get the most regressive of assets to really spike off. And I gotta chew on that one for a while, because I thought that was a really, really good point, that we're getting a lot of spending going to the top income and wealth holders, and of course it would make sense, what it is that they're going to be buying in that scenario is going to be stuff like gold. So no surprise that gold takes off when fiscal takes off, and I think that makes a lot of sense as to why gold, particularly right now, is benefiting so much from the current environment. Ghost on the half shell, are we dead yet? No, man, I'm still alive. I got plenty of life. Ballistic, free lunch when? No free lunch. Not yet. Not on my watch. All right. Doug, have you had time to poke into Steve's freshly posted macro from Macro? I haven't. I haven't even, I guess I haven't even seen that. I'll have to take a look. Brian Hassan, isn't there a big component of animal spirits to this whole thing? Yeah, there might be, but I mean the animal spirits that at least would transmit into higher asset prices. I mean, at the end of the day, you have to be willing to take money that we're going to spend on something else to buy assets, and so there has to be some sort of flow of money to support animal spirits. And I mean, there's definitely kind of a behavioral aspect that I think gets understood as animal spirits, but those animal spirits need flows. What I generally, in my framework, understand animal spirits to be is really when we get to the late stage of the Minsky cycle, where you're getting massive growth in that endogenous money spending that gets very speculative and almost Ponzi-like, right? Where loans are being created with the sole purpose of supporting asset prices. So to me, that's animal spirits, and what gets us, I guess in my framework, and what most people associate animal spirits with. And so that props up the late stage of the bubble, even when, for example, in 2000 and 2008, even when spending is really starting to fall off. So that is what I kind of take animal spirits to be. And I don't even think we're there yet. I mean, I think everything we've seen is consistent with a very strong fiscal world. And I would say animal spirits is still a year, maybe 2 years into the future. Brian, another good question. No, I don't think lowering interest rates is stimulative. I mean, lowering interest rates it collapses the term structure prices. It keeps inflation at bay. It adds no more additional interest income into the private sector. It actually makes it more difficult for banks to make loans, to make riskier loans. Not that lower interest rates in and of themselves are destimulative, I guess. I mean, but they. In no way do I see high or lower rates as stimulative. I mean, the growth, the quote unquote growth that we saw, the asset growth that we saw in the 2010s when we had 0% interest rates were completely consistent with the fiscal spending that we had at that time, just as I have up on the chart here. I mean, it completely explains it. And if you even look at like bank credit, we never got a very strong cycle in bank credit during the 2010s. And again, I attribute that in part to the very strong, in part to the very, the low interest rates. And certainly there's a part of that. And this is when I was on Steve Keenan Friends. His argument was that that was just kind of the natural steps that have to be, or that you have to go through for the Minsky cycle, kind of the deleveraging cycle. But for me, had they really jacked rates up like they did I think by 2018, right? They were starting to really go on the rate hike cycle. That is really when we started to see things pick up in terms of credit expansion and the first little blip on the radar that we saw. So overall, I would say lower rates are not stimulative. In a low rate environment, you really, 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 really need heavy government spending, which we, for the most part, I mean, we clearly got enough, and we got more than the rest of the world did during that time frame. All right, next up, not so much the flow chart as frightening depictions of the web of insanity. Yeah. I'm assuming the genuine question was relative to the lowering of interest rates. Hamel, gold and stocks. Yeah, baby. Yeah, I mean, that's what rich people are buying. I don't, I'm far from like the richest man on earth, but I know that's what I'm buying with my money. And anything else, yeah, actually, I should probably ask my wife what we're buying. Let's see. Yeah, you understood. Crypto comes to mind when talking about animal spirits. Yeah, again, though, I mean, I would argue, I guess, that I mean, crypto is just as beneficial, or is just a consequence of the credit cycle as anything else. Maybe I just misunderstand what animal spirits are. Overall, so maybe my take on animal spirits is just wrong. But yeah, I mean, I guess certainly late stage credit expansion into propping up asset prices just for the sake of propping them up. Crypto does come to mind, which I do think. I mean, look, I'm not a crypto guy, I'm not a gold guy, but I'll tell you what, I know Bitcoin. I'm pretty sure Bitcoin. Well, I guess I can just pull it up on screen here, so let me do that. Let's see if I saw the headlines here. We took a big hit in Bitcoin. I know my crypto of choice has been taking a hit. Whoops, I picked the wrong chart. Oh well, we'll still switch over here and we'll still just take a look. Where are we at? I'm gonna hide. Okay, so yeah, Bitcoin back in March we hit almost 75,000, and we're down to hit about 65,000. This is daily. Oh wow, we got a big hit today. All right, my guess here, if I had to guess, is we kind of, maybe we make like a triangle pattern if you're into patterns, and maybe we can pull all the way back, right? I mean, we just completely collapse and we hit, say, like, let's do a little technical analysis. Why not? Let's have a little fun here and do some technical analysis, fib retracement. We'll go fib retracement to the low here. We'll assume that we had one full cycle higher here. So let's say the 38.2 retrace. So yeah, right around 50,000, we'd find some support. Worst case scenario, whatever ends up playing out over the next month or two here in crypto, I would not be surprised at all if we get a major acceleration going forward. If this is if we get a real takeoff here, let's do this. Let's just speculate. Look, guys, I'm not a crypto guy. I'm not going to be investing in any of this, but let's just do like a 1-to-1 ratio. So that's we'll call that 350%, and then we'll go 350. No way. Okay, we're not going to get that high, but maybe my count is wrong. But if we, I could easily see us into 100,000. Into 100,000 of Bitcoin into the next surge here, because I think the credit cycle is just beginning, and I think they'll be highly supportive of crypto, and certainly there's still a demand for it, and it's it's what the rich are going to be buying. So no TA is just horoscopes for boys. Yeah, a lot of fun. I could easily see after a little consolidation phase that we take off. I don't need it to take off. I don't really care if it takes off. I'm not. I mean, I've got my meme coins, and I'm happy with that. And if one of them hits big, and I can double my net worth or something like that because of it, I'll be quite happy. But I don't need it to. It certainly wouldn't confirm or reject any hypothesis I have. But if I had to guess here, we'll consolidate and then take off, and I could easily see gold going up higher. But again, I mean, it's at the end of the day, that is where the behavioral insights come in, right? I mean, there isn't a desire after this kind of washout to push forward with crypto. All right, let's do this. I want to go over. There were two things that I wanted to hit tweet wise, and then I got to see as well. We're calling it. If you're just joining in tonight, we're going to be switching over to the Twitch stream at 8:00 tonight to game a little with the guys. So if that's something you want to do, I'll be dropping the link near the end, and it will just be. I mean, I'll try and pay attention the most I can to chat, but certainly if you want to do that, we're playing some Valorant tonight. But before we do that, let's go ahead and take a look at Bob's tweet and try and make heads or tails about what is going on here. So we got Bob E Unlimited, and this is his big kind of counter to the argument that we've been having that the interest income is supporting the growth here. So rising rates creating incremental income has had a minimal impact on the $6 trillion post-COVID increase in U.S. nominal GDP. Vast majority goes to non-GDP holders, central banks, pensions, rich households who save it. I believe that's what he means by HH. Chat, can you correct me if I'm wrong there? I believe that's what he means by HH. Or biz building cash. Work below suggests 1 to 200 billion GDP impact. Tiny. Often folks point to the rise of net interest by the government as fueling GDP expansion that has risen roughly 3 billion annualized pace. Vast majority, say 75%, is held by non-GDP operating entities like central banks, pensions, etc. Zero impact. GDP zero impact. The rest of the government bonds are held indirectly in money market funds held by businesses and households. Those assets total six trillion, paying roughly 5% interest or 300 billion a year. So, what GDP impact does that increased money market fund interest have? Well, half of it is held in what are called institutional funds, which cater to business cash sweep accounts, asset management holding cash in their investment accounts. Asset funds like pensions don't engage in GDP activities regardless of income earned. It just saved back, and rarely does business incrementally choose to invest because of cash earned. Okay, I think the main point that he's having here is that businesses who are earning that interest income aren't necessarily investing it back into growth, but it does allow for wages to support the higher fund structure, which is what I was getting at. So I mean, again, the money is there to support the higher prices and to support higher wage demands that might have a downward effect on demand. And again, it's going to be regressive, right? So I'm going to get, if you're, a bottom 0.25% of income earner or wealth, like you're at the bottom quarter, I get that that's, this is punishing you terribly, but in terms of the overall macro impact, certainly the wealthiest are able to afford whatever it is they want in droves. And then we're seeing this again, things like gold. I mean, it's clearly making its way into the private sector. And then again, the businesses have the ability to pay their employees more, because I think one of the main things that we need to understand is that businesses don't. I mean, if they can make a higher profit, they're not going to lay off their employees just for the hell of it. They're going to pay their employees more. Now, part of the reason layoffs occur is because they're just not able to generate the income and the necessary profit margins to hold their employees or to pay their employees more. That's part of the cycle. And so when you pull that interest income out, when the government spending starts to shrink and you can't get the acceleration necessary to support the credit structure pushing higher from just a purely endogenous cycle, then yeah, you're going to get the layoffs to happen because there's just no new income coming in to support the higher wage demands, and the profit margins start to get squeezed. But it's there. That's the whole point, is that it's there, that the income is there to pass through. And the other thing too that he's just completely missing right now, and he doesn't completely miss it. Eventually he will mention that somewhere along the way that we're not seeing a massive increase in credit demand, but there is no need for credit demand when fiscal is so strong. And that's why we're now just starting to see it, right? It's just starting to accelerate. And I knew this point would happen where everyone was saying, oh, look, credit crunch, it's going to get even worse. No. When fiscal, I'm getting at my soapbox here. When fiscal starts to accelerate, that is the healthy deleveraging that needs to take place. And it's not even right to call it deleveraging. Probably the right way to call it, or the right thing to call it, is a recapitalization of the private sector, right? And that's exactly what we were seeing during that time frame. And now, as we were pointing out earlier in the stream, we are seeing bank credit start to take off again. It is reaccelerating because the fiscal has done what it's needed to do. It's recapitalized the banking sector, and it's allowing the banking sector now to accelerate. And so he's got it all wrong. He just doesn't understand the knock-on effects here, and he's completely missing the boat. And we are starting to see that acceleration. And this is classic. This is classic one step behind. Right. I mean, this is exactly what an applied MMT approach allows you to do. Stay one step in front. Right. We got Bob, who is always seeing yesterday's data today and only interpreting what's happened in the past and not able to see the impact of what this is going to do into the future. And had he understood what the impact was of the fiscal on the banking sector, he would have understood that this is recapitalizing the banking sector, supporting the necessary growth in income to allow for those new loans to happen. And we're seeing that play out in real time. And again, that whole ilk, they're going to be so surprised that the credit cycle is kicking in. And they probably will say something like, animal spirits, this is crazy. No, this is just the natural function of how things play out. Eventually there will be animal spirits. I'm not denying that, but this is just cause and effect of how the macroeconomy works, and we're seeing it play out in real time. So I'm not seeing what Bob is seeing here. It's just, clearly, again, the other thing too, GDP growth can only come from effectively, you can only get the GDP growth that we're seeing. And I think ultimately he says somewhere in here that it's wages pushing high, or new job creation, wages pushing higher, something like that. I forget exactly what he accounts for it. But when it's all said and done, you can only get GDP growth flowing from one of three channels, and that's going to be government spending is increasing, the endogenous cycle is increasing, or we're exporting a lot more. Two of those three things haven't happened over the last year, so it's very clear that we're seeing a trickle down scenario play out, and that is what has been supporting growth. And again, I think the argument I laid out earlier in the stream, we're quickly transitioning into the endogenous cycle. So that is kind of where we're at right now. I'm gonna hit up chat here before I try and make the switch over to Twitch. Again, one of the things too, if you're new here, we talk about video games and whatnot. I've been promising that I'll try and stream on Twitch. So if you're wondering what the heck is this Twitch thing, me and my buddies, we play some Counter-Strike and Valorant on Friday nights, and we'll go ahead and do that tonight. So if you want to keep chatting, you can certainly hop on over there. But I did want to hit up a few more questions that came in. What software do I use to typically use for your visualizations? All the charts that are on AppliedMMT end up being created in Plotly, which is a Python plugin, and a handful of them I'll do Seaborn, the ones that are not dynamic where I can't roll over, but Plotly is what I'm making for the charts, and we actually need to do a bit of an overhaul in the overall chart look. I think Plotly is probably my best bet. I don't know if there's anything better in terms of everything I need, but Plotly is it. But yeah, we're going to be doing a bit of an overhaul just to clean them up, make them a little bit more visually enjoyable. Yeah, so banks like SVB folded at higher interest rates, but the rest benefit. Yeah, I mean, I think that is exactly what played out. There are winners and losers from rate hikes, no doubt about that, and there's a pivot when rate hikes occur in terms of who those winners and losers are. But at the macro level, we continue to find support here. All right, let's see. Is energy prices rising going to doing a lot of the heavy lifting and returning inflation? Yeah, very well could be. I mean, if you think about it, inflation is going to happen. Like the bad inflation, if you will, is going to happen because of supply chain issues. And if the cost of energy increases, that is just going to put a weight on the overall supply chain and will just continue to perpetuate the inflationary issues that we're seeing, and certainly get priced into CPI. Let's see. Anything else here question wise? I don't think so. Adam Luther, man, haven't seen you in a while. Good to see you again. Glad for, thanks for dropping in to the stream. In this world, I would not assume companies dump employees just for fun. Yeah, there just seems to be this this idea that, I don't know. I don't know. I don't know why there's just this assumption that capitalism stops when rate hikes occur, that there's not still a demand or desire to outcompete your neighbor. All right. Doug, we should find a mechanism to showcase prediction success rates so these revisionists can't rewrite history. Yeah, man, it is it is maddening to see people just move on. And we talk about this, just like the team and I, we talk about this quite a lot, how it's like, holy shit. I mean, how 95% of the macro world was calling for a deep, deep recession in 2023. It never came. And now we've just all moved along, right? I don't get that cycle. I mean, I think people should have a reason why they were wrong. It's to a certain extent, it's okay to be wrong. You can go back a few years, and I made a video explaining why I never thought the Fed was going to go into a rate hike cycle, and I was, I was dead wrong. Obviously, we did, but I have a fairly good explanation as to why I was wrong, and I'll admit it that I was wrong. My underlying theory wasn't wrong in the sense the Fed was the monopoly price setter of interest rates. What I was wrong about is the Fed would ever really want to start raising interest rates, knowing that there has to be an inclination and understanding that by raising interest rates, that's just going to fuel interest income. So I was certainly wrong in that, and I've kind of learned from why I'm wrong, and I've adjusted to know that the Fed is certainly capable of rising interest rates in an already kind of inflationary environment. I was surprised that they would, but we learned that, and I've adjusted accordingly and understood and made the adjustment of where I could be wrong. But the vast majority of people, I'm not seeing that. I'm not seeing that, and there should be an account for that, in my opinion. So, that is a very. I agree. Prediction success rate. They wouldn't do it though. They wouldn't do it. They would hate to see me on top of whatever chart that turned out to be. Hamel, did you see Robert Murphy tweet about 2 days ago about CPI and Fed funds rate charted? Let's see. Did he delete the tweet? I'll search him up. Bob Murphy. Was it a reply or was it directly? God, he tweets a lot. What do you know what day I'm looking for? Did he have a chart? He must have had a chart, so I'm probably looking for a chart, right? Let's see. Hamel, if you can tell me like what day it was or what I should be looking for exactly, I will scroll back through and we can. Oh, here it is. Here it is. All right, we found it. Hold on 1 second. All right, I'm not trolling everyone. I beg you, look at this chart. All right. My eyes are open. Chat. As the Fed began raising interest rates, year-over-year consumer inflation, blue line, started falling. They are both stabilizing at just the same time, and yet Kelton is running victory lap, saying the opposite. Okay, Bob, I hope you're listening. I'm going to send this part to you. about a year ago, maybe more than a year ago, I did the math. I ran the analysis. I did the statistics. And if you run Granger cause between inflation and rates, you find out that the correlation is negative over time, right? So what you can in one isolated instant, you can find the case where rates were, I'm sorry, the correlation is positive, where rates had a negative correlation with inflation. My point would be to all of this is, let me actually switch over to this. And I think recently I posted this chart right here. Yeah. Here's the thing. In causal inference, right? So causal statistics, you have there are variables that cause another variable. So your target variable that you think is caused by your input variable, there's a direct cause there, right? So one way to look at this would be is your grass wet? And the cause of that would be rain, and so that would be a direct cause. But there are also confounding factors as well that can play into that. And at any given time, you can have certain factors that are most weighted to what's actually causing. Those confounding factors can also cause, or the confounding variables can also cause the kind of leading variable to amplify its effect on what it would be, which is our target, which again is going to be inflation. So all that to say, to me, the driving variable on inflation is without a doubt the supply of goods and services. Like I can't emphasize this enough, that across the board, the strongest signals of causality, and I'm gonna phrase this now so the stats geeks don't freak out on me. The most forecastable, with inflation being the target, the most forecastable variables are always supply variables. It's always the supply of oil. It's always the supply of commodities. You can best forecast inflation with things like the supply of oil or the supply of commodities. This is best seen in the chart that I have on the screen, right? If you want to see something that's correlated, that undoubtedly has causation tied up into it, look at the global supply chain pressure index. This is a very strong correlation. And it, of course, the inflation that we saw was an effect of the fact that we had massive supply chain pressure, which means the supply was not there. The supply was gone during that point. And yes, you need for inflation to occur, in terms of, certainly in terms of kind of like debasing style inflation, you need inflation for that to occur. You're going to get kind of that sensation of kind of runaway higher prices when there's enough spending to support that higher price. But and so I'm not negating the fact that the stimulus that we saw in 2020 and 2021 was not supportive of the higher price level. It was, but the higher price level came because of the CPI. I'm sorry, came because of the supply chain index, right? Like that was the determining factor. If supply chains never get interrupted and supply never diminishes at that time, then we don't end up getting inflation. We never end up getting inflation. So that is why what played out, not what Bob is saying. And exactly as I'm seeing come into the chat, you just need to zoom out a little bit more, right? And so if you ever see a one-off and you're like, oh, that looks like it correlates, well, think about different factors that could be at play. Think about confounding factors that could be at play. So that is, that is, I think where I'm gonna end this for tonight. Like I said, Twitch, I'm gonna go live on Twitch. We're gonna try this. I actually might hit this in just a second. So I'm gonna switch over to that stream. It's gonna be twitch.tv twitch.tv/virtuous. That's my gamer name. Don't pick on me. I've had that for many, many years. Again, I will talk chat. We can keep chatting over there, but it's going to be twitch.tv/virtuous. I'm going to try and we're going to hit go live, start streaming right now. I hope I'm plugged in to, let's see if I go online chat. If you want to follow me over there, by all means. I mean, listen, it's just gonna be me. Yeah, we're live now over there. It's just gonna be me screwing around with a bunch of my buddies. So don't my feelings aren't gonna be hurt. But if you don't want to head on over there, but I know quite a few of you want to keep the chat going and kind of enjoy the community. So again, twitch.tv/virtuous. I'm gonna be over there. I'm gonna go over there right now. Thanks everyone for joining, and we will be back Monday. I was off last Monday, but we will be back. I'm off to play some on nice. Play some Rocket League. Good, Hamel. All right, everyone. I'm gonna end this stream here, and like I said, we'll be back. We will be back Monday, and should have a good time then, and have a good setup then. So until next time, everyone, good trading, and we'll see you then. Bye bye.